Good evening, everyone, and welcome to the webinar on Complete Assurance Review. Today in this webinar, we're going to go through some of the topics that you will see show up in cases for assurance. So some of the popular topics that show up in cases, and then we're going to do a case analysis at the end. I just wanted to do a sound check before we get started. So if everybody can hear me and see the slides, can you just send me a message in the chat if you can hear me and see the slides on your screen? You should be able to see a title screen. Okay, so if you can, please, a few of you, if you can message me and let me know if everything is good, and then we'll get started. Okay, so it looks like you guys are okay. The sound probably has gone because I didn't say anything until now. So it says that yes, we can see volume is good. Ranveer, you're saying that nothing is appearing on your slide. If you could restart the webinar, maybe it's just a lag. So restart the webinar and see if that works. Okay. Okay, I think there probably was no sound because I was just waiting for people to respond. Okay, you guys can hear me now. Okay. I paused to wait for people to respond, so I think that's why you didn't hear me anymore. Okay, let's get started. So I did post some webinar material, so I posted the slides. So you can see the slides on if you go to the folder called Webinar Materials Download Now, you can see the slides. And I posted the case that we're going to be doing a little bit later. So if you guys want to download those, you definitely can. If you have any questions while I'm going through the webinar, please feel free to post a message in the chat, and I'll get to it as I go along. So I will be answering questions if you post it into the chat. And at the end of the webinar, if you could please provide me your feedback on how you enjoyed the webinar, that would be really great too. Okay. So for those of you who don't know me, my name is Kiran Gurwal. I am a mentor with Prep Formula, plus doing some webinars. So I've been doing, if you guys have been with me on Tuesdays, I've been doing one every Tuesday for the past month now. Okay. So this webinar is on assurance topics. So if you guys are doing the assurance exam, or Core 1 that's going to have assurance in it, or the assurance elective role in the CFE, or just want a common understanding of assurance because you're going to have it on day 3 of the CFE, all those are good for you to be going through this webinar. Okay. So what we're going to do is we're going to cover the 5 of the most tested assurance topics and just show you the type of format that we should be using to answer those. Okay. So we'll go through that. So with assurance is different than something like taxation or financial reporting, where you would remember the rules, like remember the standards, remember the criteria. But for assurance, you need to be able to understand the theory. So there isn't really like things that you can memorize for assurance. You have to take the case facts and use them to develop your response. Okay? So you need to kind of know the theory and then be able to apply it. Don't be alarmed if you don't work in public accounting. So there's lots of people that tell me that I don't work in public accounting. I've never done an audit, so how am I going to pass the audit exam? You can still do very well on assurance topics. So don't be stressed out about that part. So you could still definitely do well. So this is going to be less technical and more how would you format the case. If you want to go watch a technical webinar on assurance, we have a webinar on the CAS standards. So we have a webinar that I've done in the past of all the different CAS standards and what they mean and what's in them. Okay, so if you want a technical webinar, go watch the CAS standards webinar. This is more of if this showed up in the case, how would you format it? How would you answer the question in the case? So that's what we're doing. So the 5 most tested assurance topics. So we'll go through each one of these and then we'll go through the case analysis. We're doing one case today that has some of these assurance topics in there. So the first one would be your basic assurance technical, just like planning the case, like fraud, what you do with fraud, like why do you do an audit in the first place, so what kind of opinion would you provide. So we'll talk about just basic assurance technical first. The audit planning memo is second, so that's usually the most popular thing that shows up on exams that have assurance in it. You have to do some part or all of the audit planning memo. So that involves risk, approach, materiality, and also includes procedures, which I've listed separately as number 3. Then we're going to look at internal controls, and lastly, special reports. Okay. So let's go to the basic assurance technical. Just want to start off by just talking about what an audit is to begin with, just so everybody's on the same page, and then we'll go into the topics. Okay. So just the basic audit technical. So obviously an audit is a process where an auditor looks at the financial statements. So if they're doing a financial statement audit, they're looking at financial statements produced by management. So this is external audit. So an external auditor is looking at financial statements that are produced by management, and they're determining if those financial statements are free of material misstatement. In order to determine that, the auditor needs to collect sufficient and appropriate audit evidence. So in order to make a judgment call on whether or not the financial statements are free of material misstatement, they'll have to make a judgment call based on the type of assurance, type of evidence they obtain. So what basically the objective of an audit is that they're going to present an opinion or provide an opinion on whether the financial statements are presented fairly in all material respects. So we're looking at whether they're presented fairly in all material respects. So what we're doing is making sure there's no material misstatements in the financial statements. So we're looking at materiality. So materiality in this case is based on relevance. So whoever's looking at our financial statements, if something is material, it's going to change the decision of a financial statement user. So if there's an investor out there and they're going to invest in the company and relying on the numbers that we have expressed an opinion on, and revenue is $1 million, for example, if revenue is off by 50,000 and there actually is an error and revenue is actually only 950,000, that might not change the decision of the investor on whether they want to invest or not. So that number, 50,000, might not be a material amount. But if an investor wants to invest, they see the financial statements, they see that revenue is $1 million, but there's actually a $200,000 error and revenue is actually $800,000, that will probably affect their decision whether to invest or not. So materiality is how much of a misstatement is there for a user to change their decision about the financial statements. So how big does this error need to be for them to change their mind or change their decision or go another way? So if there's just little minor errors here and there, that probably won't affect the users. But so that's how we determine materiality. And I'll talk about that more when we get to that section. But when we're talking about whether the financial statements are free of material error, that's what that means. So if we're checking if financial statements are presented fairly, we need to figure out what accounting standards they're using. So if they're presented fairly in IFRS or ASPE. So that's one thing we have to make sure we know. So we're saying that they're presented fairly based on ASPE requirements or based on IFRS requirements. So the basic auditing standards or basic principles that auditors have to follow is that they need to be competent. So they need adequate training and proficiency in auditing. Okay, so if you see in a case that the junior staff member is doing everything and not really being supervised and no one's really overlooking their work, then that person's probably not competent to carry out an audit. Okay? So that's one thing that you want to look at to see if the competency of the auditors, especially if there's like a new, if could be so many different scenarios that show up in the case, like something like the company is using IFRS, but this auditor has only ever audited companies that use ASPE. Now that the company is using IFRS, is the auditor competent to do the audit? Okay, so that's something that you can look at. Or if it's an audit of a industry that the company is not familiar with, or sorry, the auditor is not familiar with, like an oil and gas company that could have a lot of like complex transactions, and maybe they're not as competent to do the audit. So that's one thing you need to think about before accepting an audit client. Okay. You have to, as auditors, have due care. So you have to have sufficient, basically get sufficient evidence because the opinion that you're making has to be, you have to be pretty confident about the opinion that you're making. And then you have to be objective, have an objective state of mind. And this is where independence comes in. So there are definitely some cases that would have an independence issue that you need to be able to recognize. So there's 5 different independence threats that you want to be aware of, so you can discuss them if they show up in the case. So for example, like self-review threat. If you're reviewing if you've done the work and now you're auditing the work, that's an independence threat. So you can't review your own work. Familiarity threat, advocacy threat, self-interest threat, like if you own shares of the company that you're auditing, you're not independent, so you shouldn't be auditing them because you have self-interest of what the results of that audit are going to be. Okay? Or if you have a family member that works at that company that you're auditing, then are you really gonna just give them a bad opinion on the financial statements? And so make sure you know the different independence threats, because you might have to talk about them if it shows up in a case. All right, we have a question here. How some people are answering questions for me. Thanks, guys. All right, somebody's asking, is there a CAS that dictates the materiality ranges to use? I've always struggled with a percentage to use. So there's no definite numbers. The CAS standards don't have like a definite number that you have to use this percentage. It's really based on a judgment call. So auditors have to use professional judgment to do that. Thanks, guys, for providing some of your inputs. So I would say like 3 to 10% of net income, 0.5% to 2% of revenue or assets or expenses. Yeah, probably like 1 to 3% of equity, 1 to 4% of equity. So yeah, there really isn't a proper amount to use. It's all based on a judgment call, but you could use some guidelines, like 3 to 10% net income. But we'll talk about materiality a little bit more when we get to that section. Okay, so just a quick thing about audit opinions, what audit opinions you would be providing. So the best audit opinion that the client would like you to provide is an unqualified opinion. An unqualified opinion is also an unmodified opinion, they can call it, or a clean opinion. This is where you're saying that there are no material misstatements in the financial statements. So the financial statements are presented fairly. So there could be some errors, but these errors are not material. They're not a big enough error, and therefore the financial statements are still presented fairly. Okay. And then we have, if there are errors, so then we have a qualified opinion. So if it's not unqualified, then it's qualified. This could be due to two things. One could be a scope limitation. So you could say that, the items are presented fairly except for, and say that there is, something that we couldn't confirm. So scope limitation is when we have when we can't get the evidence that we require. So for example, if you think about inventory. So the inventory balance, the year-end inventory balance, the best way to determine that is to do an inventory count. But if the auditor was hired after year-end and was not present at the inventory count and can't really do procedures to figure out what the year-end inventory number is, then there might be a scope limitation. So you could say that, everything is good except for inventory. We weren't able to get enough evidence of that. Or if there's lots of evidence that you weren't able to get, like because the records of the company are not good and you couldn't get the evidence that you require, then you might have to give a denial of an opinion, which means that you couldn't, denial of opinion or disclaimer of opinion, that means you could not actually provide an opinion on the financial statements because you couldn't collect enough evidence to do so. Okay. Or there could be an adverse opinion, which is another type of qualified opinion. This is where there was material misstatements in the financial statements that the audit client did not decide to correct. So once an auditor finds issues or finds material misstatements in the financial statements, they're going to tell the client and say, look, I found these issues, you have to correct them. And if the client decides not to correct them, then the auditor has to issue an adverse opinion. Okay, so they do get a chance to correct the financial statements, but if they don't agree that it's an error or do not correct them, that's when the auditor would have to issue a modified or qualified opinion, an adverse opinion. Okay, so we're still talking about materiality here in the chat. So as an example, when bank requires to maintain a debt to equity ratio, what could be used as a materiality base? So you could use, so like it really depends on who the other users of the financial statements are, because you have to, like I said, I'm going to discuss materiality later, but you guys keep asking me questions about it. So it depends on who the other users are, and you're going to come up with a number that satisfies the objectives of most users. But a bank would be interested in probably net income because they want to make sure that the company is making enough money to pay their interest payments and the principal repayment at the end. Or if they're really concerned about whether they'll maintain the debt to equity ratio, you could use equity, but probably net income in that case. In a case, you might have to also talk about fraud. So another area for you to watch out for when you are reading a case is keep an eye out for fraud. So there has to be like 3 conditions, or it's called the fraud triangle. So there has to be an incentive, there has to be an opportunity, and there has to be rationalization for fraud. Okay, so an incentive for fraud. So what's the incentive of you or of the whoever it is, of the employee or management? Why are they doing the fraud? So you have to think of case facts, like look at case facts to see if there are incentives for fraud. So an incentive could be that the employee is like living beyond their needs. They have like a gambling problem, so their incentive is to use that money to pay off some gambling debts. It could be management or top level employees that are involved in fraud. Their incentive is to make sure that they get a bigger management bonus if bonuses are based on net income, for example. So think about the types of incentives you see in the case. Opportunities. So you need to be able to have an opportunity for fraud, which would be a weak internal control system. So if there's like segregation of duties issues, no approvals in place, nobody really watching what this person is doing, then they're going to have a lot of opportunity to commit fraud. And then the third one is rationalization. So how do the fraudster internally rationalize that they are okay doing this fraud? So it could be something like they're saying that they deserve it, so they deserve the money because they've done so much work and they're underpaid, or that the top level employees get paid way too much money and they deserve more of it, or that some rationalizations is that they'll pay it back, that okay, we're just stealing the money now because we need it, but we will pay it back. Okay, so you can think of if like those types of scenarios show up in the cases, then there could be like a fraud that exists. So you could talk about that. An auditor's responsibility for fraud and illegal acts. The auditor has to understand the laws and regulations that the audit client has to follow, and they may have to go to the authorities. So if an auditor finds fraud, they'll have to get a lawyer and then figure out what their options are through there, and may have to go to the authorities to discuss it. Okay. They'll probably have to also perform additional procedures if there is an indication of fraud. So if you do find that there could be fraud based on case facts, then you probably have to discuss other procedures that will have to be done. So if there is a fraud, first you want to introduce the issue. So talk about the potential fraud, and don't say that there is fraud going on for sure. Talk about the potential or the incentive for fraud, and then talk about what your responsibility is. So the CAS standard for fraud says that CPAs have to do more work or perform additional procedures to determine if fraud actually exists. So you probably have to provide additional procedures that you're going to do, and then recommend what you're going to do. So, talk to the audit committee, talk to board of directors, talk to those charged with governance, contact your lawyer. So what are you going to do if you do find fraud? Okay, so that's the kind of format that you can use for fraud cases. Okay. So those are just like kind of the basic technical. So you might have to do some discussion about what you do before you accept an audit client, so pre-engagement procedures. So something like checking for independence, checking if they're competent, checking if you're going to get all the information that you need from management, checking to see if there's any fraud. So if you know that this company has some fraud in the past or is committing fraud or something, then do you really want to be associated with that? So probably some pre-engagement procedures to determine if you should accept the audit client. You might want to discuss first, or you might have to discuss first based on the case. And then once you have, so before you decide to accept the audit client, check your independence, complete an engagement letter. That's an agreement between the auditor and the client of, who's going to do what everybody's responsibility is. You If you are auditing this company for the first time, you should be checking with a previous auditor. So call up the previous auditor and ask them if there's any reason that they can think of that should uh, any reason that they think that you should not accept the audit client. Okay, so if the previous auditor found out that there was this big, huge fraud being committed, and they withdrew from the audit engagement, then you're going to call them up and ask them, like, is there any reason I should not accept the audit client? And then they're obligated to tell you. Okay, so they are obligated to talk to you. They're obligated to provide you with the working papers of their audit. If they've done an audit in the past, they should be giving you the working paper. So that's an obligation that they have. And if you were a previous auditor, you would have the same obligation to give the new auditor your working paper files for the previous audit. Okay, so that's something that you can suggest as an auditor, that we need to get the working paper files from the previous auditor to determine if there was like sufficient evidence obtained, and this is for your opening balances. So when you're auditing the financial statements, you're not just auditing the current year. So you're not just auditing like 2018, for example. 2017 comparative financial statements are also on the financial statements you're auditing, the 2017 numbers. So you're also auditing the opening balances. Okay, so if it's the first time audit, you need to audit the opening balances or rely on the work that the previous auditor did, as long as you reviewed their working papers. And then we have to do audit planning. So after we decide that we are going to accept the audit client, then we have to do some audit planning. So if a case asks you to do an audit planning memo, there are 4 sections of an audit planning memo. This is risk, approach, materiality, and procedures. The way that I remember this is RAMP, R-A-M-P. So it's just a way for you to remember what, if the case just says, prepare an audit planning memo, you have to do RAMP. So R-A-M-P, risk, approach, materiality, and procedures. Okay, so we'll go through each one by one. Okay, so for your risk discussion, and it doesn't matter which order you do this in, like risk, approach, materiality, procedures, as long as you have them, it doesn't matter what order you discuss them in. Okay, so for risk, there is 4 components of risks in an audit engagement. Audit risk, inherent risk, control risk, and detection risk. So inherent risk is a risk of material misstatement in the financial statements arising from some error or omission. So inherent risk is outside of your control, so outside of the auditor's control. It's just basically the circumstances of the audit client. So if the audit client is in a really competitive environment, do they have like the incentives to create a misstatement in the financial statements? Is there a lot of pressure on them because their management bonus is based on income that could give them an incentive to commit fraud and have a material misstatement on the financial statements? If the bookkeeper is inexperienced, that could lead to a risk of material misstatements. If the transactions are really complex, that could lead to a risk of material misstatement. So inherent risks are the risks inherent in the company before any controls have been put in place. So you're looking for any reasons why there could be a material misstatement in the financial statements. Control risk is a risk of material misstatement in the financial statements arising from either an absence or failure of controls. So either there aren't controls in place to detect or prevent misstatements, or there are controls in place, but they're not working properly. Okay, so this is all based on the controls of the company, how strong the controls are. Okay, so both inherent risk and control risk make up the risk of material misstatements. This is usually what you have to discuss in a case. So when they talk about the risk discussion, you're usually talking about is there a risk of material misstatement? So you can kind of lump inherent risk and control risk and just talk about the bullet points together. Or the case might tell you to discuss each of the components of the risk formula or the risk model. So AR equals IR times CR times DR is called the risk model or the audit risk formula. So you might have to discuss each of these, or you just talk about the risk of material misstatement, which includes inherent risk or control risk. And so depending on how your case goes, if your case just says do a risk discussion, then you're probably okay with just talking about inherent risk and control risk. So audit risk, the definition of an audit risk is the risk that you're going to provide the wrong opinion on the financial statements. Okay, so if you said that there was an unmodified opinion when there actually should have been a modified opinion. Okay, so there's a risk that you're going to provide a wrong opinion on the financial statements. So we always want to lower that audit risk as low as possible. Okay, so we don't want there to be a high risk that we're going to, as auditors, provide an inappropriate opinion on the financial statements. So usually we set audit risk as low as possible. So 5% is usually what companies set audit risk at, or the highest they'll set audit risk at, because they don't want more than 5% risk that they're going to issue a wrong opinion. Detection risk is a risk that auditors will fail to detect a material misstatement in the financial statements. So it's a risk that they'll do the work and then miss something. Okay. So inherent risk and control risk are outside of our control. That's just the case facts. So case facts will tell you if the inherent risk or control risk is high, medium, or low. Audit risk we set ourselves. So we set what audit risk is. So we say audit risk should be 5%. So therefore, we need to determine what detection risk is. Okay, so if there's a risk that we're going to fail to detect misstatements, then we actually have to do more work in order to reduce that risk. Okay, so we want to do more work in order to lower our detection risk. So detection risk is something that we can control based on how much evidence we look at and how many samples we do. The more evidence we look at, the less we'll have a risk that we're going to fail to miss something. Okay, so we have a couple questions here. How does the auditor reduce the audit risk? The auditor sets the audit risk. So the auditor sets what their audit risk is going to be. Usually it's not higher than 5%. So they say, I'm going to make my audit risk 5%. Inherent risk and control risk are outside of their control, which means detection risk is in their control. The lower the detection risk, the more procedures, the more evidence we have to obtain, the more samples we have to choose. Okay, so if you want to if inherent risk and control risk are high, and you know that audit risk has to be low, then you have to lower detection risk. Then you have to make detection risk really low, which means you have to do a lot more work. Okay? If inherent risk and control risk are already low, and you know you want to make audit risk low, then you can kind of increase your detection risk and not do as much work. And so I hope that makes sense. Another question, I don't understand why in CASA says risk of material misstatement at the assertion level and not at the overall financial statement level. So when you are doing this in a case and you have to do a risk discussion, you're probably looking at the overall financial statement level, so looking at all the errors that could show up. When you're doing procedures, then you're looking at the risk of material misstatement at the assertion levels. Okay, so when we're looking at procedures, I'll talk about risk again in the procedures section, and that's when you do it based on the assertions, so in the assertion level. When you're talking about procedures, and when you're looking at the overall financial statement level, that's when this risk discussion or in your audit planning memo comes in. Okay, so that's your risk discussion, and we are gonna, when we go through the case, we will do an example where we'll kind of look at the risks and figure out if they're control risks or inherent risks. Approach is the A in RAMP. So there's two types of approaches that that we will pick, I don't know why it says 3 applications. So there's 2 types of approaches. So 2 approaches that you choose, either a combined approach or substantive procedures or a substantive approach. Okay, so under the approach section, we're talking about how the auditor is going to approach the audit. And there's 2 types. There's a combined approach or combined tests, or there's substantive approach. And you have to pick between the 2 of those. Okay. So a combined approach combines test of controls and substantive procedures. Okay, so combined approach, test of controls and substantive procedures. And then the substantive approach only provides substantive procedures. Okay, so what auditors do when they test controls, when they test controls, they're testing the actual processes. So we were talking about control risk and whether controls are weak or not. When we're looking at test of controls, we're actually auditing the specific controls. So for example, if there was a control that the company has in place where they say that any purchase orders over $1,000 needs to be approved by management. So that's their control. So they say, yep, we have controls in place. One of our controls is each purchase order over $1,000 is approved by management. Management has to sign off. When we're doing a test of control, we're testing to make sure that that's correct. So we're looking at purchase orders over $1,000 and checking if there's a manager's signature on them. When we're doing substantive procedures, we're testing the actual balances in our financial statements. So that we're testing the revenue balance. If the revenue says that it's $1 million, then we're testing to make sure that's correct. Or if inventory says we have $500,000 in inventory, we're checking to make sure that's correct. So test of controls tests the actual processes, and substantive tests the actual numbers. So how you decide between the 2 of them, so a combined approach does both test of controls and substantive procedures, or you just pick substantive approach. So you have to have substantive procedures in each approach. Okay? And you may or may not have test of controls. So combined approach has test of controls, substantive approach doesn't have test of controls. So the only way that you can do a test of controls is if controls are reliable or controls are strong. So when you're talking about the approach section in a case, you have to make an analysis on controls. So what you do is take a look at the case facts, figure out whether there's weak or strong controls in place. So talk about, there seems to be strong controls in place because of so-and-so reason, and only if there's strong controls in place can you do a test of controls. If there are weak controls in place, then you're going to do substantive procedures. Right? So if the controls are strong and you need case facts to support that, then you can say we're going to do a combined approach. If controls are weak, then you say that we're going to do substantive procedures. Because you're not going to test controls if controls are weak, because you already know that they're weak. So you would only test controls if you think they're strong, and you're going to test them to make sure that they're strong. Okay. Okay, so let's address some of these questions here. So Alicia is saying, you mean inherent risk and control risk can exist for assertions? So technically, yes. So there could be, for example, there could be inherent risk that management bonus is tied to net income. So there could be risk that there would be a higher risk of material misstatement because management has an incentive to increase the revenue. Okay, so that assertion that you're looking at is a occurrence. All right, another question. Can the approach change at the beginning of the audit and after by developing the audit? So the approach, you will only be able to discuss or to determine the approach after you gain an understanding of controls. So once you gain an appropriate understanding of controls and decide that controls are strong, then you could do test of controls and substantive procedures. So if through getting more understanding of controls, you can, if at the beginning you might say we're going to do substantive because there's a couple controls that aren't strong. Like from our assessment so far, controls are weak. But if you assess it even further and realize that, wait, some of these controls are strong, so we can do test of controls, then you're going to do, then you can change it, yeah. Okay. Another question, if there is low value large transactions, which procedure is better? So the ideal approach is a combined approach. Okay, so regardless of what type of transactions there are, an ideal approach is doing a combined approach, which tests test of controls and substantive procedures. Okay. But you not always can do test of controls because controls are not reliable. Okay. So if controls are not reliable, then you can't do a combined approach. But that is the ideal approach because it provides for a more efficient audit. So usually that's what you're going to do if controls are strong. If there are low value, large transactions, so if there's a lot of transactions and they're very low value, it's going to be quite hard to do substantive procedures only because you're going to have to like sample a lot of transactions in order to obtain enough evidence. If ideally if you can do test of controls on low volume large transactions, that would be ideal, but you can only do it again if controls are reliable. So why does the case ask you what the approach would be when you're not even started the audit? You have to gain an understanding of controls. So if through the case there are case facts that lead to whether controls are strong or not, then you can make your assessment of an audit approach. All right, so another thing under like the approach section, you could talk about sampling. This doesn't really show up too much in cases, like what to sample. I feel like it would show up if you talked about if they did incorrect samples or if they found errors in the samples that they've chosen. We want to increase the sample size. But obviously we're not going to test every single invoice out there. We're going to sample. So figure out how many to sample, like how many invoices to sample, for example. That's going to depend on detection risk. The lower your detection risk, the more samples you have to obtain. I've never seen a case where it asks you how many you need to sample, so I don't think that's going to end up showing up. But we can use like statistical sampling or non-statistical sampling. So statistical sampling is like we can test every 10th invoice or every 20th invoice. Non-statistical sampling is you just randomly pick out samples. So either or can be used, but I don't really see sampling show up too much in these cases. Okay, but if they're, just note that the lower the detection risk, the more samples you have to do. So you might have to discuss that we need to increase our sample size because detection risk is low. If an auditor does find misstatements in the sample that they've chosen, then they're probably going to increase their sample size to see if there are more misstatements. So are the misstatements just for those 10 samples that they found, or could there be more? And to do that, maybe increase the sample size. All right, so we're on materiality, the M in RAMP. So we've already talked about materiality a lot, I feel, through your questions. But basically, materiality is, for example, like I said, it's the level of misstatement that will make a difference to the users, that will lead them to make a decision that's different than the decision they would have made if like that error wasn't there. So what's the largest amount of uncorrected misstatement? that could exist in the financial statements, and they still will not change their mind about whether to invest or whether to not invest or what it is that they're looking at from the financial statements. So it's if something's material, it's likely to influence the economic decisions of the financial statement users. Okay, so it's going to change the decision of the financial statement users, which means that when you're talking about materiality, you have to discuss the users of the financial statements. So the first thing that you're doing when you're talking about materiality is discuss the users. So discuss who the users are and what their objectives are with the audit. So what are they looking at in the audit? What numbers most concern them? What numbers are they would like to focus on? So we were talking about like how the bank probably would focus on net income to make sure that the company has enough money to pay the interest payments and the principal repayment. If it's just like one owner of the company, a private company, then the owner is probably also focused on net income. If you have a net loss, then you're probably more focused on revenue. Like the first few years, you're probably spending a lot of money on expenses and stuff, so you're probably more focused on revenue than your net income numbers. Then you would use revenue. So it really depends on the users of the financial statement. So talk about who the users are, talk about their objectives and concerns of the financial statements, and then come up with a materiality basis depending on the users. Okay, so depending on the users. Okay. So and like I said, these are just guidelines. So 5 to 10% of net income, 0.5 to 1.5, 2% of total assets or revenue. Those are the three most popular ones. So net income, revenue, and assets are the three most popular ones. If you want to choose net income, but it's a net loss, then you'll probably choose revenue. Or like a startup or something would be more concerned about revenue than they would be net income because they're probably not making a lot of net income. Like a real estate organization that has a lot of assets would probably be concerned about the total assets of the company. We can use expenses for not-for-profit organizations. I think somebody mentioned that already. Okay, so first thing, talk about what amount you're going to use. Are you going to use net income? Are you going to use total assets? Are you going to use revenue? Are you going to use expenses? This is based on the users of the financial statements. So you have to explain why you're using net income by linking it back to the users. Then you're going to decide on the percentage. So to decide on the percentage, some qualitative factors you can use is whether this is the first year engagement. So if this is the first time you're doing it, a lower percentage is probably what you'll use. If it's a new management team, they're inexperienced. If there's fraud going on, all those would lead to a lower percentage. So if 5 to 10% is a range, you'd probably use more around 5%. Especially also if it's really important, this number is really important to the financial statement users, you want to have the most lower percentage. Okay, so if there's just one owner, it's a private company, then maybe you can do a higher percentage. But if there's a lot of users, there's like a lot of like incentives to manipulate the numbers, there's a lot of pressure, then you probably want to use a lower percentage. Sometimes you'll have to calculate what the materiality is. So after you probably have to adjust it for any financial statement issues, any financial reporting errors. So your accounting issues, basically, you probably have to adjust it for that. And you probably have to adjust it for any abnormal or recurring items. So if there was like a unusual year-end bonus, or they sold one of their buildings, which they don't usually do or something, then get rid of any like one-time items and normalize the net income before you apply the percentage. All right, question here. So if there is a high risk and large samples, which risk are you talking about though? So if there's a high inherent risk and high control risk, and you want to keep audit risk low, then detection risk will have to be low, and therefore you'd have to do a larger sample. So the lower the detection risk, the higher your sample size. Okay, so audit risk you always want to keep at a low level. So depending on what inherent risk and control risk are, if inherent risk and control risk are high, so if the risk of material misstatement is high, then you need to make detection risk really low, which would require a larger sample. So the lower the detection risk, the higher the sample size. All right, so if you had to talk about RAMP in a case, so for the risks for like a module exam, for a core 1 exam, I would say provide like 3 risks. So focus more on like risk of material misstatement, which is inherent risk and control risk. I'd probably do 4 to 5 for like a CFE day 3 case. For a day 2 case CFE, how many risks you have to provide it really depends on case facts. I'd probably say more around like 7 or 8 risks, but it really depends on how many case facts you have. Like if you're trying to pull out case facts, and it doesn't really seem too obvious and you're just trying to pull from anywhere and having a hard time, then you probably don't have to provide that many. So it really depends on case facts how many you're going to provide, but basically you would discuss the factors that would increase risk of material misstatement, factors that would decrease the risk of material misstatement, and then come up with a conclusion on what the overall risk is, so either high, medium, or low. You want to do a balanced discussion, especially for a day 2 assurance role case. So you want to make sure you have factors that increase risk and factors that decrease risk, right? So at least 1 factor or 2 factors that decrease risk to balance out your discussion, and then make sure you do a conclusion on what the risk level is. For approach, you're going to say whether you're going to do combined approach or substantive approach, and explain why. So your explanation of why you're doing combined is that controls are strong. So make sure you bring in case facts and explain why controls are strong. Or you talk about how controls are weak and then that you're doing substantive. For materiality, explain who your users are. So explain the users, explain their objectives, and what they're most concerned about in the financial statements. Then pick your materiality basis based on the users, and pick your percentage based on the users, and then you might have to calculate materiality as well. For materiality, usually for like a day 2 assurance level role case, you also would have to talk about performance materiality, and maybe even specific materiality. So performance materiality is like a buffer basically on whole materiality. So if you've picked 5% of net income, which ends up being $100,000, for example, your performance materiality is like a buffer that's going to be lower than $100,000. So like kind of like a just in case thing, like gives you a buffer. That's usually 60 to 90% of whole materiality, and that's based on your risk. So the higher the risk of material misstatement, the lower you want your percentage for performance materiality to be. Okay, so more around 60%. The lower the risk of material misstatement, the higher you can make your performance materiality. Yes, you might have to talk about performance materiality. You might have to talk about specific materiality. So there sometimes is a different materiality number for specific accounts. So if there's some accounts that are more high risk than others, then you might want a specific materiality on those. So for example, if the bank is giving you a line of credit and the line of credit is the amount you're going to get on your line of credit is based on the total amount of your inventory and accounts receivable balances, then you probably will have to do a specific materiality on your inventory and accounts receivable balance, which is going to be lower than overall materiality. And then procedures, part of your audit planning memo, which I will talk about next. Before I do that, let me answer some of these questions. Okay, so once you set materiality at 5% of net income before tax, When do you use lower or higher materiality? I don't really understand your question. When you set materiality at 5% net income, when would you use a lower or higher materiality? So you wouldn't. If you've set materiality at 5%, that's the materiality that you would use. I think you're probably talking about performance materiality, maybe, which somebody already asks, and I think I answered that question. So if you still have a question about performance materiality, I did just discuss it. So basically, it's a buffer because you want to make sure that you kind of cover all your bases. So you make it like a buffer of 80% or 70%, and like test all your samples lower than performance materiality, or sorry, higher than performance materiality. When do we need to talk about performance materiality? You need to talk about it in day 2 for sure. If you're doing assurance as your role, talk about performance materiality. In day 3 or core level or like module level, so in the assurance exam I would talk about it. So in the assurance elective exam I would talk about it, but for the other ones, just talk about it specifically if been asked. Okay, so assurance elective and day 2, if your role is assurance, definitely talk about performance materiality and maybe even specific materiality if there are higher risk accounts. And then for the other exams, talk about it if directed. All right, so let's move on to procedures. Okay, so your audit procedures is your P in your RAMP, so in your audit planning memo. So lots of different procedures. So like inspection, and you want to use these wordings. You want to use the wordings like inspect, like observe, like compute or recalculate, confirmation, inquiry, analysis, because they kind of look for keywords. Okay, so inspection involves looking at invoices, records, physical assets. You're vouching and tracing. So vouching means you're going from the GL and vouching the so you're starting with a GL. So if the GL says there's one transaction that had $10,000 of revenue, you're vouching to the supporting documentation to determine if there actually is an invoice related to that, or do they just make up that 10,000. You can also be tracing. Tracing goes the other way around. You're looking at the invoice and then making sure that it is recorded on the financial statement, so recorded in the GL. Observations, so you can watch the staff perform procedures. It's probably not the best audit procedure because if you're watching somebody do something, they're going to make sure they do it properly if they know that they're being watched. But it is a good way to determine if the controls are strong. So if you observe what happens on a day-to-day basis, you can see if there are controls in place or not. Okay? Computation or recalculation, so recalculating depreciation, allows for doubtful accounts, recalculating foreign exchange rates, maybe recalculating the fair value versus carrying amount if you're revaluing to fair value. So just you can talk about recalculating the numbers. Confirmation, getting third-party confirmations to make sure that getting evidence from a third party rather than your audit client is always obviously better. So getting accounts payable confirmations, accounts receivable confirmations, bank confirmations, all those you can discuss to get. Inquiry, so inquire or discuss with the management. Inquiry is not enough of an audit procedure. When you're doing inquiry, you have to, that's not enough. So you can inquire with management about something, but you have to corroborate that evidence. So you have to be able to corroborate what they're saying. You just don't rely on what they're saying. Right? And then analysis is like ratio analysis, comparing like analytical procedures. So comparing from last year to this year, doing some ratio analysis. You do it at the beginning of the audit to see if there is anything that looks kind of weird. Like, if they say they lost a bunch of customers, but revenue went up from last year to this year, that doesn't really make sense. So that would probably be a riskier account. And then you do it at the end of the audit as well, after all the adjustments, to make sure things make sense. After all the adjustments you've asked the client to make. And things still don't make sense, then you go back and ask them. All right, so before going to the next slide, let me still answer the questions. So still talking about performance materiality. So for example, if you said that your materiality basis is net income and you're using 5% of net income, and that gives you 100,000. So your materiality is 100,000. So if you find errors above 100,000, those are material, and you're going to ask the client to adjust those, or you're going to provide an adverse opinion. Okay? But you're going to want a buffer, because there could be a few different errors. There could be a $60,000 error and there could be a $70,000 error. Both those together the total of both those will be material, but on their own they won't be. So you want to set up a buffer materiality, and that's what performance materiality is for anything that if you aggregate some of the errors, will that lead to a misstatement, a material misstatement in the financial statements. Okay, so you set up a buffer. So you set up a buffer materiality or performance materiality of $60,000, for example. So in this case, you're going to audit everything over $60,000 instead of audit samples over $60,000 instead of auditing samples over $100,000, just in case there's two $60,000 errors, because that's going to be over your materiality. Okay, so it's kind of like a just in case buffer. Just in case I have two errors that are $99,000 that I'm not going to find if my materiality is 100,000, I'm going to have a little buffer of something lower. So when I'm going through and choosing my samples are going to be higher than the performance materiality number, not the materiality number, just in case that the errors will add up to $100,000. Okay, so hope that makes sense now. Another question, in a review engagement, the inquiry procedures need to be verified as well? No. In a review engagement, the procedures that you do is analytical procedures, inquiry, and discussion. Those are the only procedures that you would do in a review engagement. Unless something is really high risk, then you can do other procedures like, get a bank confirmation, or like a loan agreement, or like, obtain a loan agreement or something like that. So if there's like really high risk accounts, you could do a little bit more, but usually you're going to just stick to analytical procedures, inquiry, discussion. When should we use WIR approach? I'm going to get to that. You guys are ahead of me all the time, so I will get to WIR approach in the next section. Okay. All right, so procedures. So audit procedures. So I think audit procedures are probably the hardest, most challenging, that people have the most difficulty doing audit procedures, and a lot of people are scared of doing audit procedures. So they don't have to be. Like when you look at audit procedures, don't think that, because I've never done an audit in the past, I can't think of audit procedures. You have to think of, you have to have some, not common sense, but be creative. So you want to be creative when you're coming up with procedures. So if you know that there's a risk that revenue is overstated, what type of procedure would you do to to make yourself feel better that revenue is actually not overstated? So basically, what you need to do is think about the type of steps that you would do to make sure that number is correct. So would you, talk to the customer? Would you look at the backup information? Would you look at the invoices? What documents would you look at? So usually what you do is you either start from your general ledger, your GL, and then go to the supporting documentation and explain what supporting documentation that you're obtaining, or you start with the supporting documentation and then check if it's in the financial statements. So check if it's in the general ledger. So if something is overstated, you're usually checking the general ledger first, seeing that that's number showing up, and then checking your source documents or supporting documents. And you want to make sure that you talk about what are the supporting documents you're going to look at. Are you going to look at invoices? Are you going to look at purchase orders? Are you going to look at bank confirmations? Like, what are you looking at here? So when you are doing audit procedures, the way that I want you guys to format it, and you'll see the format in another slide, but is to first talk about the risk with that account, talk about the assertion that you're trying to satisfy, and then talk about the procedure. Okay, so the assertions, like for the balance sheet, are existence. So you could be testing for existence. So you could be testing to see if they've recorded an asset, how do you know that asset actually exists? So what you're going to do is do a procedure to make sure the asset exists. So if they say that, they have this machinery as part of their capital assets, to figure out if that machinery actually exists, you should go and inspect it, right? So say, show me in this factory where this machinery is. So you can go inspect the machinery. You can look at the invoice to make sure that they have the invoice. Look at the serial number in the invoice, match it to the serial number on the actual machinery, and say, okay, yeah, you do have it. It does exist. Rights and obligations is another one. So making sure that those assets are owned. So how do you know that the machinery is actually owned and not just like leased, for example? So in this case, you would look at the purchase agreement, making sure that there's purchase agreements or like a contract, or maybe an invoice satisfies as a purchase agreement. And you want to make sure that the liabilities are obligations of the entity. So looking at like loan agreements from the bank, like obtaining the loan agreement from the bank to make sure that it's an actual liability of this company that you're auditing and not maybe like a related party. Completeness would be the opposite of existence. So here you're making sure that everything on the financial statements is complete. There's nothing missing. So for existence, you're looking at the financial statements and making sure that the numbers actually exist. Completeness, you're making sure nothing's missing. Okay, so there's, no assets missing, no liabilities, no equities. So usually, more often than not, liabilities are missing, not assets. So making sure all the liabilities of the company is actually recorded. And then valuation and allocation is making sure the amount is actually correct. Okay, so existence talks about like it satisfies overstatement. So if there's any risk that accounts are overstated, you would test existence. If there's any risk that accounts are understated, you would test completeness. And if there's risk that they're incorrect amounts, then you would test valuation. So if you are a Part Formula student, we do have a document that goes through like possible procedures of each type of account. So it goes through like, the accounts receivable section. What kind of procedures could you discuss in the accounts receivable section? So if you are registered in one of like the Prep Formula courses, email education@prepformula.com and ask them for the listing of procedures by financial reporting section, and then they'll provide you with that. Okay. Because then you'll just get examples of different types of procedures that you could use for different accounts. For the income statement, there was one assertion missing for the balance sheet. I just realized. I'll update the slides, but presentation is another one. So presentation should be another assertion for the balance sheet, and that's making sure that things are presented properly. So if something's a current asset, it's presented as a current asset, not a long term. Same with liabilities. And like disclosure is part of presentation as well, making sure things are disclosed properly. For the income statement, occurrence is the same thing as existence. So making sure that revenue is not overstated or expenses are not overstated. Completeness is the same thing. Accuracy is like evaluation, making sure the amount is correct. Cutoff, making sure that everything as up until year end is included and anything past year end isn't included. And then classification, making sure that the amounts are recorded in the proper accounts. So something is, like when you think of classification, repairs and maintenance versus whether it should be capitalized, like, how to classify the account as an expense or capitalize it is always a thing you want to discuss. So the format. So people are asking me about the format of RAP. Okay, so people know that there is a RAP format. So RAMP, you use RAMP when RAMP is your audit planning memo. So your audit planning memo is your risk approach, materiality, and procedures. Okay, so RAMP is the 4 sections of your audit planning memo. So when you're asked to do an audit planning memo, you choose RAMP. The P in RAMP is your procedures. When you're discussing procedures, the format that you should be using is RAP. So risk, assertion, procedure. Okay, so the risk should come from case facts. So why is that account you're looking at risky? So is there a risk that revenue is overstated because they're recording it when cash is received? Okay? Or is there a risk that revenue is understated because they're waiting until cash is received to record it? Then you're gonna state what your assertion is. So if you've explained your risk pretty well, you don't have to explain your assertion, like you've already done that in your risk section. So then you just state completeness or existence or evaluation. And then discuss the procedure. So the procedure, I always say that when you're discussing the procedure, be very detailed. Like discuss the procedure like you're gonna tell a junior staff member what to do. So if you're gonna tell a junior staff member, hey, go out and do this procedure, the way that you're gonna explain how to do the procedure to them right before they go do it is how you should write it. So if you say, first do this, then look at this, then look at this, that's how you should be discussing it. So you can say, pull a sample of revenue items from the GL and then vouch to the invoice. And then your next step is to explain what are you looking for in the invoice. Okay, so first step, take a sample from the GL, vouch it to the appropriate invoice, and then what are you looking at in the invoice? Are you looking at if the amount is correct? Or are you recalculating the revenue based on how much has been performed so far? Are you looking at the date of when the sale was made, or when the sale was made, and maybe linking that to the shipping documents to see when it was actually shipped to know when to record the revenue, like so cut off in this period or next period, right? So you want to make sure you're explaining where you're starting, what you're looking at. Don't just say check the supporting documentation. You have to explain what supporting documentation. So is it a purchase order? Is it shipping documents? Is it a legal letter? Is it a AR confirmation? So what is it? And what are you looking at in that actual document? So you want to make sure that you're detailed. This will only come with practice. So the more cases you do, the more cases you debrief, the better you will be at developing audit procedures. And especially if you do get that document that I was telling you, so email education@prepformula.com. It's only if you are doing a course through Prep Formula, like the CFE Prep course or Core 1 course or something. that will give you a starting point on where to head for each type of account. All right, there's a lot to cover in this webinar, so I'll try to go through this so we can actually go through the case. So WIR, somebody was asking about that. That is your next topic. So next topic is internal controls. So auditors need to gain an understanding of internal controls. So that's like one thing that auditors have to do. And they can also test controls if the controls seem that they're reliable, right? But the minimum is that they have to gain an understanding of controls. So through the understanding of controls, auditors can determine if controls are weak or not. When we're looking at controls, we want to look at controls in the information system. So how things get recorded in the system. So how do they first, is it manual entry? Is it all automatic? Like an automatic would be a stronger control than manual. Look at control activities, which are the policies and procedures. So is there authorizations and approvals in place? Is there performance reviews done? Is there physical controls to control, to safeguard the assets? So like if you have a warehouse, is the warehouse locked? Are there security cameras? Is there security? Is there good inventory management of what's coming in and out? Are they counting inventory on a regular basis? And then segregation of duties is always a popular one. Okay. So when you're looking at internal controls, there's a few areas where this will hit your audit planning memo. First one is when you're assessing control risk. So if you're assessing the risk of material misstatement based on controls, you can talk about some of the lack of internal controls. When you're talking about your approach section, you need to talk about whether controls are strong or weak to determine what your approach is. When you're talking about, and then you might also have to discuss any internal control weaknesses. Okay, so that could be outside of your audit planning memo. They might want you to talk about the internal control weaknesses in the company. Okay. So you're looking for any deviations from these internal control objectives. So hiring capable, competent, trustworthy, ethical personnel. So that would include doing background checks of employees before hiring them. So if they don't do that, and then that's a control weakness. Having segregation of duties. So making sure that a different person is collecting cash and recording cash and depositing cash. Proper authorization, so making sure that certain individuals are tasked with authorizing purchase orders or signing checks, maintaining documents and records, making sure there's proper controls in place for that. Safeguarding over access to assets, talked about that, and records, making sure that records are kept safe. So either somewhere in a cloud or in a fireproof container outside of off-site somewhere. Periodic independent verifications, reconciliations, like a bank reconciliation, making sure that's done on a monthly basis. Inventory count, making sure that's done maybe quarterly. And then making sure that there's something in place to check errors. So if that there isn't these in place, then that's something that you probably have to discuss. So auditors are responsible for understanding controls, maybe testing controls if they're reliable, and also commenting on deficiencies of controls. Okay, so if we see deficiencies in controls, we have to discuss those as well. Companies or your audit client have to keep a document and description of all their types of controls. So how do they control cash? How do they control inventory, fixed assets, stuff like that. So they will have an internal control document showing these are all the controls that we have in place, and that's how the auditor will understand the internal controls of the company. Okay, so what's their controls around payroll records? Is the same person that's hiring the people paying the people? So that's a lack of segregation of duties, because somebody could just hire their friend and then pay them more money, right? So you want to look at what type of controls that they're discussing. So if the case does just say that you need to discuss internal control weaknesses of the company, this is where your WIR approach comes in. Okay, so if you're tasked with, if one of your AOs is to discuss the internal control weaknesses, then the way that you want to lay this out is weakness, implication, recommendation. So your weakness, that's coming from case facts. Okay, so that's basically just explaining the case fact. So you don't have to spend so much time on the weakness because you're just regurgitating case fact. The implication is explaining what will happen if this weakness does not get resolved. So if your weakness is that, Tim creates invoices, enters information, collects payment, and deposits the amounts, then your implication, talk about how this is a lack of segregation of duties and what will happen if this doesn't get resolved. So if this doesn't get resolved, this could lead to fraud because Tim can create a fake invoice and pay himself. Right. And collect the payment and pay himself. So for the implication, you have to be answering the question, so what? Okay, so if you're saying, this is the weakness that's coming from case facts, implication is explaining, so what? What is going to happen if this doesn't get resolved? Will it lead to fraud, and how? Will it lead to a misstatement in the financial statements? Will it lead to loss of sales? Will it lead to, having a bad reputation of this company? What is going to happen? Okay, so the so what. And then in your recommendation, you want to suggest how to fix the control or suggest a new control. So, for example, split up the duties. When you're talking about what duties to, so don't just say segregate duties. Explain which duties need to be segregated and how they're going to do that. So you want to explain how the company's going to do it, who's going to do it. So if you say approval should be in place, so should approvals be in place for, should a low-level employee be approving it, or management or a supervisor? So if you don't have the names of the people, if it's not a small company and you don't know the names of the important people, then say the title. And then you also want to explain how often. So if you're saying there should be an inventory count done, don't say inventory count done regularly or periodically. Explain how often. So on monthly or quarterly or annually. Okay, so how it should be done, who should be doing it, and how often it should be done. Okay, so weakness, implication, recommendation there. All right, so that's another big topic that does show up in a lot of cases. So make sure you know how to do that. Okay? Last topic I want to discuss before we get into the case, and we are running out of time, I wanted to have more time on the case, is special reports. So there's different types of reports. So what we've been talking about is audit report, but there also is review engagements, which we talked about briefly when I was saying what type of procedures to do. So an audit report provides positive assurance. So the objective is to determine if financial statements are presented fairly in all material respects. A review engagement gives negative assurance. So they just determine if the financial statements are plausible. So they're saying that nothing has come to their attention that would lead them to believe that financial statements are materially misstated, but they didn't really do enough work to determine if they are materially misstated or not. Okay, so nothing's coming to their attention. Compilation report provides no assurance. It's also called a notice to reader. This is basically the audit firm putting together the financial statements. So they get all the information from the audit client and they create financial statements. So the auditor does not comment on whether the financial statements are free of misstatements or not. They just collect the information from the client and then make financial statements. They don't need to review what was provided and check it for accuracy. Or there could be some special reports. Special reports could give positive, negative, or no assurance. So we'll talk about the different types of special reports. But whether the client does an audit, review, or compilation is really based on the users of the financial statements. So if a user requires an audit, then they'll have to do an audit, or they might require a review. So a lot of the times for cases, you're comparing audit engagement versus review engagement and determining what the client would need. So does the client so maybe discuss the pros and cons of review, pros and cons of audit, and then make a decision of what they should do. Okay, so should they get a review engagement or an audit engagement? And I'll talk about the format in a second. Okay. Or there could be special reports. So there could be in cases where it discusses what type of special report that an audit client should get. So the audit client will give you a scenario of, I need some type of assurance on this, this, and this, and you have to come up with what type of report would be best for them. So when you're talking about the type of report, you might want to, you probably have to come up with 2 or 3 different types of special reports, or two to three different types of options that the client would have, and then provide a recommendation on what's the best option. So talk about the pros and cons of each option, and then what the best one is. Okay. So I'll quickly kind of run through these special reports, as I do want to make sure we have some time to analyze the case. So CAS 805 is audit of a single financial statement. So if an audit client just wants an audit of their inventory balance, because maybe the bank or somebody's requiring just an audit of their inventory, then you would use CAS 805 and just audit inventory, or just audit revenue, or just audit AR. Right? If a client wants an audit on summary financial statements, so like the historical financial statements, or just summary 5-year financial statement comparisons, then you would use CAS 810. If the client wants reporting on controls at a service organization, so sometimes what happens is that a service organization is used for something. So for example, like for payroll. So for your payroll function, instead of the company doing the payroll functions, they outsource it to a third party or to a service organization. An auditor can't audit that service organization if they're your client. Like if your client is getting a third party to do something, the auditor can't really go and just audit the third party because they're not their auditors. So they're gonna get a type 1 or type 2 report. A type 1 report gives an understanding of internal controls. A type 2 report provides a test of internal controls. Okay. So those are the 2 types of reports. But basically, if you're getting a report, like you as an auditor, you may ask to do a report on controls of the service organization. So you're the service organization's auditors, and then the client that's using the service organization, their auditors will get a type 1 or type 2 report from you. Review engagements they've changed the standard on review engagements. It's CSRE 2400. So again, it's negative assurance. So review engagements. It used to be that there used to be different special reports on review engagements. Now they've lumped it all in this one standard. So it used to be split before. Now it's just one. CSAE 3530, 3531. These are engagements to report on compliance. Okay, so, for example, if a client has to comply with environmental regulations for some reason, then you could suggest this report, that they have a report on compliance, because that will the auditor will see if they're complying with the environmental standards, or if they're complying with like loan covenants, or proceeds of a property sale, or something like that. So if there's any compliance that the audit client has to do with some type of law, regulation, or some type of contract, then you can use that. CSAE 3000, so engagements other than audits or reviews of historical information. 7600, reports on applications of accounting principles. So if an auditor is kind of unsure whether an accounting principle is correct or not, they can get another accountant to provide their opinion on some complex transactions. Okay, so they could do that. Yeah, so there's a bunch of these, which you're going to need to know each one of them, because you might have to, just, like I said, discuss 2 or 3 of them, talk about the pros and cons of each, and then come up with which one's the best. Okay. Another one is Section 9100, reports on applying specific audit procedures to financial statement information other than financial statements. So here you're providing specific audit procedures, so you and the audit client agree on what the audit procedures are going to be, and you perform those procedures and give the audit client the results. There's no opinion provided there. Okay? Similar with Section 9110, agreed upon procedures regarding internal controls. So you and the audit client agree what procedures they're going to be doing. The auditor does those procedures and provides a report on these are the results of the procedures. So no recommendations or anything is provided there. It's just here are the results of the procedures that we agreed on. And then, like we said, notice to readers or compilations, that's Section 9200. So that's just creating the financial statements. All right, there's some questions here, which I'll answer before I move on to the format. So if assurance is not our elective, do you think we'll be tested on special reports? You definitely can be. So I haven't really seen it show up too much in Core 1, but they can definitely put it in if they wanted to. They can put it in day 3 of the CFE if they want to. So yeah, they can do it if they want to. So yes, you should review that. What's the difference between assurance and auditing? So assurance is the type of, I guess, like looking at like the type of evidence you're getting, the type of assurance you're providing this client. So an audit provides positive assurance. So they provide positive assurance that the financial statements are free of material misstatements. So they do a bunch of work, obtain a bunch of evidence to provide a good amount of assurance to financial statement users that the financial statements are free of material misstatements. For reviews, reviews provide negative assurance. So reviews don't provide like as much confidence to the financial statement users that the financial statements are free of material misstatements. Positive assurance does. No assurance means that you're not providing an opinion on whether the financial statements are misstated or not. You're just preparing the financial statements. You're not looking at whether they're misstated or not. Yeah, so I hope that makes sense. Reviews are negative assurance. Section 7600, an assurance engagement. Nope, it is not an assurance engagement. It is basically just it's an opinion. It is an opinion provided by another auditor, another accountant, on their opinion on what accounting principle is the best. Negative assurance opinion means nothing has come to our attention. That's correct. Does Section 5815 report still exist? No, it does not. It has been taken over by CSAE 3530. During the CFE, can we go into the handbook and get the special reports names and descriptions, or do you recommend memorizing them? So there's going to be a lot you're going to have to remember. If you are doing the assurance role, I would say try to remember, but some of these get difficult to remember the number. So yeah, you can definitely go into the handbook and find them. Just make sure you know where in the handbook to look for them. So like practice going into the handbook, looking at the, figuring out what's the best way to search to find these. Okay, so make sure you know, if you're not going to remember the names, make sure you know where to get them fast. Okay, so either or. I know going to the handbook takes more time, but that's why you want to practice with how to get the information more efficiently. Section 8600 is gone as well. It's replaced by CSAE 2400, review engagements. Okay. All right, so the format when you're discussing special reports, like I said, discuss 2 or 3 types of special reports. So if they say, we need some assurance on our inventory number. So think about like 2 or 3 types of reports that could fit the user's needs. So explain what the report name is, the level of assurance. So is it review level assurance? Is it audit level assurance? Is it no assurance? Explain the pros and cons of each. So what the cost is going to be. So a review level type of special report is less costly than an audit level report. Compilations are going to be the cheapest. What type of procedures? So we talked about how review level is just inquiry, analytical procedures, and discussion. And then like the other differences between the reports, like one only looks at specific, like just the inventory count. Other ones look at all the accounts. Right. And then you have to make sure you talk about the users. So what are your users looking for? So if your users are saying that we only want to look at inventory, then when you're talking about that CAS 805, so you say this would be a good report for these users because they just focused on the inventory number. Okay, so talk about what are the users looking for, how is this report going to satisfy the users? And then once you talk about all of those for the different types of reports you're going to have, then you conclude or recommend on which one you're choosing. Okay, so recommend one of your alternatives and then explain why. So you can say, we're going to use CAS 805 because it provides the users with the most information, because they're only looking at the inventory number, and it's going to cost the least amount because rather than doing a whole audit, it's going to be cheaper just to look at one amount. Okay. So just make sure you support your recommendation. So just support your recommendation, but like as long as you support your recommendation, it doesn't really matter which one you conclude. Okay. All right. Okay. So that is it for talking about the topics. Now I want to go through the case analysis. So there's just kind of a summary here of the type of formats, but we did go through all this, so I'll let you guys look at the summary slides yourself. Let's go through the case. Okay, so the case is case 42. And like I said, I have posted it. We only have 20 minutes left for the case, unfortunately, but we'll try to get through what we can. And then I will provide the solution. So I will post the solution after this webinar so you guys can take a look at how the rest of it was done. So we're not going to be able to cover all of it. Okay, so I'll give you a chance to pull up the case. I'm pulling it up as well, and while we do that, I'll answer some of the questions. Section 8600 is similar to 5815, but review level. Yes, that is right. So selection of special reports is an election rather than compulsion. So selection of special reports. So this is like if case facts say that the audit client wants, or the client wants to get a special report done for so and so reason, like, so, environmental laws and regulations, the government requires the audit client to submit a report on compliance, like to submit a report to make sure that they're complying with the rules and the regulations. What type of report could we get? So it's going to be in the case. So the clients don't need to get a special report. They just do it if there is some sort of requirement to do so from a user of the financial statements. I just missed a question up here. Where is it in the handbook? So I'm assuming you're talking about special reports, Tracy. So special reports, they're in the assurance section. So if you go into the assurance section, you're gonna just have to like find the numbers, like 2400, 3000. Like you'll be able to go through and find them. So they're not in the CAS standards. They're below all the CAS standards. So you'll see the listing of all the CAS standards, like 240, 500, 700, and then below all of that, you'll see the different numbers for the special reports. Okay. All right. So let's look at this case. Wait. Yes, Mohammed, you're right. Yeah, 5815 and 8600 have been replaced. I think Ruby was just mentioning how 5815 is gone, and then so is 8600, but they used to be the same. All right, let's go through this case. Like I said, I will post the solution, so we'll try to get as far as we can, and then and if you guys have any questions about it afterwards, we can definitely chat offline. Okay. So SFL operates 12 upscale fitness clubs located in the Greater Toronto Area. They offer high-tech facilities. It was founded in 1996 from its original owner. Devon is the it was purchased from the original owner in December 2015 by Devon, who believes fitness club has grown strong potential, and he was impressed that a new fitness club opens every 3 months. Having exhausted his own savings to purchase shares, Devon has approached the bank to obtain financing. The loan agreement says that the financial statements have to be in accordance to ASPE and include an unqualified report. So right off the bat, you already know. So Devon's one user. So I'll just tell you that you guys are gonna have to do an audit planning memo for this. You'll find out in a bit, but you'll have to do an audit planning memo. So Devon's a user and the bank is a user. Okay, so you want to make sure that you kind of like, especially for day 2 assurance or assurance elective, you're trying to like go through these to figure out. You don't know exactly what to do yet, but you're kind of pointing these out as you go along. Okay, so accounting standards for private enterprises, so they use ASPE. Year end is September 30th. Okay, that's always important because you want to know where in your year, if you're past year end, if you're before year end. They want an unqualified report. SFL has never been audited before. So here you want to kind of note that, okay, so if they've never been audited before, this probably increases their risk of material misstatements, because this is the first time that this auditor is going to audit them. As a result, in June 2017, Devon approached your firm for assistance. So BB has accepted the audit engagement, and you are an audit senior. Okay, so that's your role. You're an audit senior. For some reason, my mouse isn't letting me highlight things. Okay, so your role is you're an audit senior. It is now July 4th. which means it's before year end. So year end was September 30th, or is September 30th. You're July 4th. So you're before year end, which means that there is like time to do the audit. You can go to the year end inventory count, stuff like that. So you're meeting with the audit partner. So this memo that you're going to have to write is going to go to the audit partner. So you're doing an audit. So Rosie begins and says that Devin is unsophisticated when it comes to financial matters. So I would see that as a risk of material misstatement. So the fact that he's unsophisticated could mean that there's errors in the financial statements. Okay. So when it comes to financial matters, he is unsophisticated. So I would say that would be a risk that could increase the risk of material misstatement. So then he relies entirely on his bookkeeper to prepare the financial statements. So first of all, it's a bookkeeper, not like an accountant, like not a CPA doing it. If he relies entirely on its bookkeeper, like I could already think of maybe there could be a segregation of duties issue if the bookkeeper is doing everything. I don't really know, but at least it kind of gets your brain kind of thinking about this kind of stuff. So you can kind of maybe write like, SOD, segregation of duties, a question mark beside it. Devin is also finding it difficult to manage SFL. He provided a list of complaints he received, not sure how to deal with them. He would like us to perform an assessment of controls and any weaknesses. Okay, so we need to provide an assessment of control. So that's one of our AOs. So WIR, weakness, implication, recommendation. We'll have to go through that. Devin has also stated that although SFL earned about $500,000 of net income last year, he's very concerned about the possibility of losing his life savings. He's asked us to identify the risks impacting future profitability. Okay, and how he can mitigate those risks. So that's more of a strategy and governance issue. Okay, so talking about the risks that will impact future profitability and suggesting how to mitigate those risks. So Rosie has asked to prepare a memo addressing Devin's concerns. She said the memo include any preliminary audit planning issues and analysis of accounting issues and their impact on the audit. Okay, so basically preliminary audit issues is basically saying do an audit planning memo. Okay, so preliminary, audit planning memo is what it's asking, and then an accounting issues and the impact on the audit. So this is probably not very as directed as you probably get on the CPA exam. So it probably, like, the impact on the audit means audit procedures. I think in the exam it will just flat out say audit procedures and not say impact of the audit. Okay? And then you are given a whole bunch of information. So already, like, if you have to do an audit planning memo, we've already identified some of the risks. Like, Devin is unsophisticated, bookkeeper does everything, they've never been audited before, so that could increase the risk of material misstatements in the opening balances. And because this, like, B&B, first time doing the audit, we don't have very much experience in the audit. The bank is a user, so there could be like pressure for Devin to show really good financial statements in order to obtain financing. So that could be like incentive to, increase revenue or something, which would make the material misstatements, which would increase the risk of material misstatements. So just kind of skimming through this case, the second page talks about the list of complaints from members and staff. So a number of members have complained that the monthly fee has been charged to their credit card after the membership is canceled. Member complained that her credit card was charged twice for the monthly fee. Member claimed that he purchased a 1-year membership, but his credit card was charged for a long-term membership. So all of these I can see as weaknesses in their internal controls. Right? So here it looks like they have a bunch of weaknesses. They're not canceling people's memberships properly. They're charging twice for monthly fees. Credit cards are being rejected, right? So it says that number 4 says that they spend a lot of time dealing with credit card numbers are rejected as being unvalid. So sometimes a member entered the number incorrectly, or sometimes there's an error made by the receptionist while entering it into the system. Okay, so what do you guys think of the internal controls of this company? So if you're thinking about your audit approach, what kind of audit approach would there be? So there's, like I said, for internal controls, so they asked you to prepare a memo on the weaknesses and recommendations. So here we have to talk about the weaknesses in the internal controls and implication and recommendation of how to fix it. It's also going to affect our risk of material misstatements, right? The more in control risk, the higher the risk of material misstatements. And it's also going to affect our approach section. So what approach would just looking at these few errors that are happening so far, what approach would you suggest when you're talking about your audit planning memo? All right, so some people are saying substantive, internal control is weak. Is there a safe number of weaknesses to discuss them on the CFE? Okay, hold on, let me answer the question first. So substantive procedures, so you can, discuss some of those weaknesses and say the internal controls are weak. Because of you just discuss a couple reasons, so because of so-and-so reason, therefore we have to use substantive procedures. Okay, so you already know that there are some weaknesses, so you probably need to use substantive procedures there for your approach. Question, is there a safe number of weaknesses to discuss in the CFE? I feel like we can spend a lot of time here if we discuss them all. So yeah, definitely don't have to discuss them all. When you're picking and choosing which internal control weaknesses to discuss, I would choose the ones that are going to have the biggest implication. So the fact that credit card information is denied, that means the company's not going to get their money. So that's probably a bigger issue than maybe some of the other ones, or the fact that their credit card is being charged twice. That's going to really piss the customers off or the members off, and then they're going to it's going to affect the reputation of the company. If people hear that, oh, don't go to this gym, they rip you off by charging you twice in a month or something like that, and then it's going to lose sales. How many weaknesses do we need to discuss? There is no answer to that, unfortunately. So the way that they mark these CPA exams is they look at how everybody else did, how many majority of people, or however many people that they want to pass, how many those people were able to do, and then they base it on that. So if everybody's able to do 5 internal control issues and you're only able to do 3, then you're probably not going to get a C or competent response on that. But if everybody is only doing, if majority of the people are only doing 3, and so are you, then 3 is probably the magic number. So there's no way of knowing how many you need. It's based on case facts. So you look at how many case facts are provided to you. Look at the time that you have to do them. Look at all the other requirements that you have to do. But on the safe side, I would probably say 4 to 5 for a day 3 type case. For a day 2 assurance type, probably more around 6. So it really depends on how everybody else is doing. So there's no magic number. You have to look at case facts, look at how much time you have, look at all the other requirements, and try to do as many as you can in the time frame. All right, so yeah, so a bunch of internal control issues we found. So you can talk about how that's going to increase your risk of material misstatement. So you can talk about that in your risk section. You can talk about that in your approach section, and then you'll have to talk about that when you talk about the weakness implication recommendation. They're also telling us description of their operations in the next page. So they're saying to purchase a membership, a customer must meet with sales representative. So they're just saying step by step what their processes are. So again, this would be internal control issues, right? So it says the receptionist complained that the system is slow and freezes when she tries to submit a contract. So there's a internal control issue that they have system freezes. Cancellations. Members often call a club or send emails to cancel. Sometimes they miss out and forget to cancel. So this is basically kind of linking to the complaints. So you're saying, why is there so many complaints? It's because these are the types of processes they have in place. Okay, so it's just kind of linking to that. So that's part of your internal control analysis. Again, for the next 2 pages, talks about security. So just looking at these, figuring out what internal control issues are here. Okay, so they give out some temporary passes without photos are kept in the drawer. Temporary passes are given to new members to try until their photo IDs are processed. But apparently they should only be using them for a week, I think. And apparently there's some people that have kept the temporary passes for a long time. Okay, so again, another internal control weakness. And you can take a look at the implication recommendation in the solution of how they solved that. After that, it talks about accounting issues. So you can take a look at the various accounting issues. You're going to have to also discuss the accounting or the audit procedures on these accounting issues. So that's where the procedures come in. So revenue for all memberships is recognized when received. Okay, so you already know, like, that's an issue for. So for a gym membership, if you pay, upfront, for example, like upfront for a year or something, you prepay for the whole year. Revenue is recognized when the cash is received, which we know is not correct. So you'd have to go through the revenue recognition rules for that, discuss how it should be recorded, and then we also have to do an audit procedure. So your risk in this case, I would get you guys to do it, but we don't have much time. So risk in this case would be, there's a risk that revenue is overstated because revenue is being recognized when cash is received, not when performance is achieved. So that would be the risk that you would talk about. The assertion, so if revenue is overstated, the assertion is usually occurrence for that one. So you would say occurrence. Could also be like accuracy, so determining if the amount of revenue is correct. And then you would come up with the audit procedure. So for the audit procedure, again, step-by-step audit procedure, and you can take a look at the solution for this, but step-by-step audit procedure on, so saying, you would start with a GL for this one. So occurrence, you usually start with a GL. So take a sample of revenue items from the GL for like long-term memberships, for example, and vouch to the contract, so the membership contract, right? Determine when the membership started to whatever date the year end is, so September 30th, right? So the membership started a month ago. And let's recalculate how much revenue should be recorded based on the number of months that have already been passed divided by the total number of months that they've bought for their long-term membership or something like that. So explain like where you're starting from, where you're going, and what you're looking at in that supporting documentation. So there are obviously solutions provided, or I'll provide these right when this webinar is over. So let me just quickly show you. So we talked about what the audit approach was going to be. We talked about some of the risks and material misstatements. For materiality, let me just quickly show you. So in the solution they talked about independence, but there's nothing in the case to question the independence. So I will only talk about independence if there is something in the case that leads you to think that there's an independence issue. Otherwise, you wouldn't really have to talk about it. Okay? Materiality. So we talked about the fact that the users are Devin and the bank. Okay? You'll notice that, like, once you read the rest of it, you'll notice that there isn't any more users, just Devin and the bank. So you want to talk about both of the users. You want to talk about what the users are concerned with in the financial statements. So, what's the bank looking at the financial statements for? What is Devin looking at the financial statements for? In this solution, they said, they're both looking at net income. So we're going to choose net income, and we're going to choose 5%. But they are in a loss position. So, or they will be in a loss position when you correct the net income amount for all their accounting issues. So usually if they're in a loss position, you don't really use net income. In this case, they're saying that we should use revenue instead. Okay. And then, again, performance materiality, if this is kind of like a day 2 case. So then it talks about risks. The risk is the bank is relying on financial statements. Therefore, there could be a risk that management might be biased or manipulate the financial statements to make them look better. We talked about the bookkeeper, how they might have a lack of knowledge. Devin is unsophisticated when it comes to matters. So we've talked about some of these risks, right? Internal controls are weak. You can link back to, your internal control analysis and say, based on my internal control analysis of my weaknesses below, internal controls are weak, and that increases the risk. Okay? When you're talking about risks, you want to talk about, so you want to state the case fact and then explain why it increases or decreases the risk. Okay, so case fact and explain why this will increase or decrease the risk of material misstatements. And then again, like I said, you need to have a conclusion on the risk level. So this, for some reason, the solution didn't, they said that it should be high. So the solution is saying that the risk should be high based on the following reasons. So either you put your, what the risk level is at the top or at the bottom. It doesn't really matter. Okay, so they're at the top. They're saying the risk is high based on the following reasons. And then approach, we talked about that already. Most of you guys said it's substantive. And then you just move on to audit procedures. So audit procedures are within the financial accounting issues, which is fine. So sometimes people put audit procedures right after each accounting issue, and that's okay to do. It's a risk assertion procedure for that one. All right, so definitely went a few minutes over time, but if you're discussing all the types of different assurance topics that could show up in cases, it does take a little while. So sorry if I was a little fast at the end when talking about this case. But I am going to post the solution for this case on in the same area, the webinar materials folder. So I'll do that right after I finish. And if you guys have any other questions or anything, just send me a message. So just find me on the Prep Formula website and then send me a message, because I know I kind of rushed it at the end. Okay, but you guys had some good questions. You guys participated. So I was glad I was able to answer all your questions. But if you have any more, feel free to find me on the Prep Formula website and message me on the side. Okay, so thank you everyone for a great webinar. And have a good night. Sorry, I went a couple minutes over time. But like I said, any questions, let me know. Okay, take care, guys. Have a good night.